As we move into the second quarter of 2023, are we headed for a new regime in the markets, or are we going back to the future? Will we experience continued uncertainty around the Fed, inflation, and market volatility, or is there another view brewing on the horizon? A conversation well worth your 10 minutes right here on UBS Trending. Hi, everybody, and welcome to UBS Trending. I'm your host, Anthony Pastore. I'm joined today by Dr. David Kelly, Chief Global Strategist from JP Morgan Asset Management. David, great to see you. Thanks for coming in. David, there would probably be any time in the markets where it would be a good time to sit with you, but I feel like today is probably a good opportune moment. And I wanted to start with the idea that you, in an interview last fall, maybe around October, said something along the lines of we were going back to the future, and you were referring to pre-pandemic levels, of course, when you were referring to the Fed, inflation, and all of that. Do you think that's still the case a few months later?
Yeah, I do. I mean, we sort of talk about the roller coaster we've all been on, but one of the things about a roller coaster is you actually get off where you got on. And we got on in an environment of slow growth, low inflation, 2% inflation, low interest rates. And I think when all is said and done, by the time we get to 2024, 2025, we're going to be back at slow growth, low inflation, and low interest rates. So I think that's where we're headed. I think it's very important for people to try to invest beyond the cycle and think about where we're going to be in a few years rather than where we are this year.
So you're long-term-ish, if you're looking at it that way.
Well, yes, long-term-ish, but also recognize that there's a lot of volatility and there's a lot of bumpiness caused by the inflation that we saw last year, and indeed caused by the pandemic, which is wringing its way out of the system. So you've got to really look at, well, where are we going to be when all that's done? Because long-term investing is long-term investing. It's not about trying to figure out how you make the most money between now and the end of the year. It's how do you invest so that over the years you make good returns. And I think that comes from really understanding where we're going to be in the middle of this decade, not where we're going to be in the next few months.
Right. And you mentioned volatility. Clearly, we're still experiencing it. Do you attribute this to inflation, or maybe are there recession fears on the horizon? Is it rate hike fears? There's so much that could potentially be causing the vol. Where do you think it's coming from these days?
I think a lot of it's actually coming from the Federal Reserve, because we've got a fairly good sense of what the economic growth is doing. It's slowing down. We might have a recession. If we have a recession, I don't think it's going to be that deep. I mean, we're on the edge of something, but we're not on the edge of a cliff. We might be on the edge of a swamp. So I think it's it could be slow and sticky, but I don't think it's a big recession. But the real problem is we know inflation's coming down also, but we just don't know when the Federal Reserve is going to pivot. And so they could push rates up one more time and then hold them there for the rest of the year and into 2024. Or they could, if the economy gets weak, they could just change their minds altogether and start cutting. And when they start cutting, they could cut a lot. And so I think that's really what's causing the volatility in the bond market. It's just we don't know exactly what the Fed's going to do going forward.
Right. I mean, that's really one of the things that I've heard you even speak about was, does the Fed feel like we need to go into a recession to kind of kill their direction so that they can actually start that pivot at some point this year?
Yeah, unfortunately, it seems to be that that's their intention. I mean, if you look at they put out forecasts every quarter when they have one of their meetings every quarter. And their forecast is saying the unemployment rate is going to go up by about 1% between now and the end of the year. And that economic growth is going to be about 0.4% year over year by the end of this year. Well, both of those numbers suggest negative economic growth in the second, third, and fourth quarters. And it also suggests that at some stage we're going to actually be losing payroll jobs. So the Federal Reserve is already saying, we want to kill inflation, and by the way, we don't mind causing a recession to do it. Now, I don't agree with them. I think inflation is going to go away on its own, and it's not worth the price to put the economy into recession just to achieve that result faster. But that does seem to be what they're thinking.
Yeah, I mean, it seems like every time we turn around, that Powell and the Fed are repeating 2% target for inflation. It's their 2% inflation target, yet they're still data dependent. It doesn't seem likely that we'll hit that 2% by the end of this year, or even maybe the first half of 24.
Well, absolutely, and but that's actually natural. Inflation does take some time to come down. I mean, if you have, suppose, look at wages. You get a wage increase every year, which will take some account, perhaps, of inflation in the past year. So you've got some big inflation, you maybe get partially compensated. You get a slightly smaller inflation rate, you still get some partial compensation. So it's not like we've got a price wage spiral, we've got a price wage slinky. The inflation and wage growth are coming down, but they're just coming down slowly. And if you will just let that play out, by 2024, the end of 2024, I think we will be at 2%. In 2025, you know what? We're going to be back, as I said, back to the future. We're going to be back to where we were in 2015, the inflation rate below 2%, and the Federal Reserve sort of puzzling, how do we get it back up to 2?
And round robin, here we go again, back on the roller coaster up the hill.
Well, yes. I mean, I think they'll be a little smarter this time around. I don't think they're going to try to push interest rates all the way down to 0 because, frankly, that's very disruptive to the whole financial system. I think that's really what we've seen, actually.
Well, hopefully they'll look in the rearview mirror when they get to that level and know where they're going to go next.
Yes.
Right. I want to switch gears a little bit with you, David. Our Chief Investment Office here, I know you've done a lot with our CIO here over the years, are right now with one of their new messages in focus talking about buying quality bonds, especially as inflation is starting to recede a little bit. And of course, we're looking at investment grade, sustainable bonds, agency MBS. What's your view here? Do you feel like that's a good place for investors to be right now?
Well, absolutely, particularly if they're sitting in cash, because I think one of the natural reactions to a period of volatility or uncertainty is to just pile up in cash and sit in a CD or a money market fund. The thing about doing that, so suppose you get into a CD, the problem is you're getting a good rate right now, but what are you going to reinvest it in? Mm-hmm. And actually, we've sort of taken a look at this, and historically when we've seen interest rate cycles, when you get to that peak CD rate, yes, it gives you good return over the next year, but in almost every case, high quality fixed income actually gives you a better return over the next year because long-term interest rates come down. Long-term bonds tend to be a much better diversifier in a portfolio than cash. Cash just kind of sits there. If the stock market goes down, long-term bonds tend to go up, and so I think this is a time to think about what we'd call duration, having a long-term bond which will zig if the stock market zags, and give you a better return in the long run.
Right, and obviously when we're looking at the 10-year Treasury, it's been a pretty wild ride there as well, with yields kind of coming down quite a bit when the banks were having their issues a couple of weeks ago, but now holding a little steadier at this point.
Well, that's right, and they are better yields than we've seen for many years, and it's sort of, I don't think it's going to last. That's the point. It's like a this year only sale. So I think this year you get good yields. I couldn't have said that at any time over the last 15 years. And I probably won't be able to say it much over the next 15 years. But for this year, we've got good high yields on long-term bonds. This is not a bad time to make sure that you've got that bond allocation fully stocked up.
Terrific, which we're also telling our clients and investors as well. Thank you, David. What about OPEC? Over the weekend, they said they're going to cut $1 million of production per day. What do you think is happening here?
I think the actual announcement from the OPEC Plus group and Russia that they're going to reduce output by more than 1 million barrels a day, I don't think that's terribly alarming. It actually kind of makes sense because the global economy is slowing. The U.S. economy, or the U.S. economy is slowing, and the Chinese economy is not coming back nearly as fast as they thought. So we're actually we've got too much supply in the world. So I get why they're cutting back a bit. I'm a little bit more concerned about sort of this collection of autocrats around the world who seem to be having all these meetings and seem to be getting on in a very chummy way. I don't like that. I believe in democracy and I believe in democratic principles. So I don't like the idea that this is a way of helping out Russia or helping out China. So I think that's a little bit more disturbing. But the actual move, I think, is probably appropriate from an OPEC Plus perspective. But also remember, the United States produces far more oil than, say, Russia does, or indeed than Saudi Arabia does. And our production is ramping up. So in the long run, the higher they keep that price, the more the U.S. is going to ramp up its energy production, the more the world is going to conserve on fossil fuel energy. So in the short run, they can have a big impact on oil markets. In the long run, I'm not so sure about that.
Right. And certainly not asking you for a price target here, but some of our mutual competitors are looking for $100 a barrel for oil due to this cut. You think we're going to hit that? Not
due to this cut.
Right.
And if we did hit $100 a barrel, it would be the worst possible thing for the OPEC Plus group, because what it would do is it would just ramp up production all around the world. It would also ramp up conservation and a switch to green energy, which I think is happening anyway, but it would just accelerate it. I mean, it's like we saw this huge spike in natural gas prices in Europe last fall. Everybody thought that means a recession in Europe. But basically everybody just turned down the thermostat, started wearing coats inside,
right?
And they said we're not cold at all, and you know what? They didn't consume any gas, and so natural gas prices are right back down to where they started. So if you push the price up too high, you will force more production from elsewhere. You'll force conservation. The price is going to come back down.
Right, and as we said earlier, just look at history. it has a way of repeating itself, and you don't want to make those same mistakes again.
Absolutely.
David, thank you so much. Always a pleasure to have you. We've got to get you in here more often.
Anytime.
It's always great to have you.
Love to do that, Anthony.
Great. David Kelly again from JP Morgan Asset Management, Chief Global Strategist. David, thank you. And for more information on anything from UBS side and our great partners like David and JP Morgan Asset Management, visit our Insights website at ubs.com/views. Plus, you can check out on the social media side our newly relaunched UBS Trending Instagram page. There's great content, lots of sound bites, other promotional videos, and great information for you. So follow us there. And as always, if you do have any questions about your own portfolio, make sure to speak with a financial advisor. Until next time, I'm Anthony Pastore. We hope you have a great rest of your day. And remember to keep your eyes on what's trending. We'll see you soon.